I don't know if you've ever heard the difference. There's a fixed rate and a non-fixed rate, also known as a variable rate. Now, what is the difference between a fixed rate and a variable rate? Let's talk about it. But before we start, if you could please like and subscribe and also comment below on other video topics you would like for me to discuss in the future. Your comments and feedback are always appreciated. When you're purchasing a property, you do have an interest rate like we talked about before. This is the interest that you pay back to the mortgage company who provided you the mortgage to buy the home in the first place. If you do buy a property and you do get an interest rate, it's important to know if you have a fixed rate or a non-fixed rate. Non-fixed rate, or also known as a variable rate, is a rate that is not fixed throughout the entire term of the loan. So if you start at an interest rate of, let's just say 5% on your property, in 2 to 3 months, it could stay 5% those first 2-3 months, but by month 4, it could go up to 7%. So instead of paying, let's say maybe $2,500 a month on your property, now you're paying on month 4, $3,200 a month because your rate just went up 2 points after 4 months of owning the home, which was also a part of that recession that maybe you've heard from your parents, grandparents talk about in 2008. A lot of those home buyers back then were getting non-fixed variable rates in 05, 06, 07, and after a couple months of owning the property, their rates skyrocketed. They had a whole new mortgage payment after 3 months of owning the home, and now they're about to go into foreclosure, and that happened to a lot of people, and it's really tragic. That's why you have me to go over this now. With the variable rate, keep in mind, this is more for HELOCs, credit cards. If you have a Chase credit card, if you have a Citibank card, you'll see it on your statement. Now, when you're getting a fixed rate, you are typically getting a fixed rate so you can lock in the rate and you're not paying anything different monthly. It's locked in. You're paying a set amount of interest for the whole term of the agreement. So if you have a 15-year term or a 30-year term and you have a fixed rate, you should not see any changes with your rate for the entire period, which will mean that you will have the same consistent monthly payment until you pay off the loan. Very simple. Common types of fixed rates will be your home loan or your auto loan. And again, the variable, it's more like HELOCs, credit cards, things to that nature. So a fixed rate obviously sounds a lot more appealing. Now, the only downside with a fixed rate is if you are, let's say in this market, and you have a high rate, the averages are about 7.58%. Obviously, you don't want to be locked into that rate for the whole 30 years, but don't worry, because if that's the biggest con, a fixed rate is still better to go than a variable rate. Because with a fixed rate, if you lock in at, let's say 8%, but in 1 year, the average rates go down to like 4%, 5%, you will most likely be able to refinance your mortgage depending on your loan terms. And if you are able to refinance in a year or two from an 8% to a 4%, you are gonna save hundreds on hundreds on hundreds of dollars on your monthly payment. So even if you are getting a fixed rate and it's a little bit higher than what you wanted it to be, there's always an opportunity to lower it to a new fixed rate by doing a refinance. But you never have to worry about the rate changing throughout the time, only when you do a refinance. And that's the beauty of having a fixed rate to start off with, is you're in control of your monthly payment and how it goes after you buy it.